Hi, welcome to Behind the Data with me, Glen Pereira. Today we are diving into key factors shaping the energy market since our last update at the end of March. Our top three drivers behind the prices for April have been tariffs, liquefied natural gas, also known as LNG, and weather conditions. The first major driver is tariffs. The President of the United States referred to as Liberation Day the introduction of reciprocal tariffs, meaning the US would introduce significant tariffs on countries with a trade deficit with the US. In addition, a universal 10% tariff was placed on imports on all countries, including the UK. The purpose? To counter what the administration viewed as unfair trade practices. These tariffs aim to both support US manufacturing by making imported goods more expensive and strengthen American position in trade negotiation. And markets reacted swiftly. Global markets, including commodities, dropped sharply after the announcement. Investor sentiment worsened further when China signaled a response of equivalent tariffs. The rising threat of prolonged trade war triggered a broad sell-off as concerns over slower global growth took hold. As you can see from the graph, gas prices were particularly affected, falling more than 15% as the markets interpreted the dispute as a risk to industrial output and global energy demand, both of which are closely tied to the health of global economy. Shortly after, the President of the United States announced a full 3-month pause on all reciprocal tariffs. This move helped ease market tension, triggering a partial recovery as investors welcomed the improved economic outlook and signs of renewed dialogue among several key trading partners. However, this pause didn't extend to China, the world's second largest economy. In fact, tariffs on Chinese imports were set to climb further, bringing the effective rate to 145% after Beijing responded with additional retaliatory measure on US goods. This escalation put a lid on market gains as trade tensions between the two global heavyweights remained a key source of uncertainty. In a notable shift, China has begun granting exemption on certain US imports and is now asking businesses to identify critical goods that they need to be exempt from the 125% tariffs. This move suggests growing concerns in Beijing about the broader economic fallout of the ongoing trade disputes. It also comes amid signals from US officials that the White House may be looking to ease tensions, offering a potential path towards de-escalation between the two sides. Our second driver is LNG. Thanks to strong US production, Europe is receiving a record number of LNG cargoes. LNG imports into Europe for April have surged by 33% compared to the same period last year. A major contributor is the Plaquemines LNG plant, which has been steadily ramping up production since the start of the year. As you can see from the graph, output from the facility rose more than 20% in the second half of April compared to the first, further boosting the global supply. Meanwhile, the ongoing tariff disputes between China and US has led Chinese LNG buyers with long-term contracts to divert US-sourced cargoes to Europe, following tariffs imposed on American energy products. As China has not imported any US LNG since February, the redirection has contributed to a record number of US vessels arriving in the UK, with Europe also receiving a record number of send-out. Moving into our final driver, the weather. Weather continues to play a key role in the market dynamics, as you can see from the graph. April brought warmer than usual conditions, with average temperatures around 1 degree above seasonal norm and noticeably higher than the past 2 years. This unseasonal warmth kept heating demand low, leading to an 18% year-on-year drop. At the same time, lower wind output supported stronger gas for power demand. Looking ahead, with this seasonal shift in mind, attention is increasingly turning to storage. UK gas injections have remained steady this month, showing a little improvement on the previous year. However, the sentiment around European storage is beginning to shift. On 24th April, the EU moved closer to adopting more flexible gas storage rules, with a key committee approving a proposal to extend refill targets to 2027, but at a reduced threshold. Instead of the original 90% minimum, storage operators may now only be required to reach 83% capacity ahead of winter. While this adjustment offers some relief during the summer injection season, it also introduces a new risk. Entering winter with low reserves could leave the market exposed if colder weather or higher demand materializes. In that case, prices could rise and volatility could return, particularly during peak winter months when gas is crucial for both heating, and power generation. As summer nears, temperatures will have less impact on energy market, with focus shifting to global LNG. Taiwan CPC has signed a preliminary LNG deal with Alaska, with as a strategic move. The US is also hosting an energy summit in June, aiming to secure similar interests from Japan and South Korea. Meanwhile, Japanese buyers are watching Australia's May 3rd election closely amid the growing concern over the future LNG reliability and cost. Thank you for your time. I hope you found this update useful.